The Indian rupee has slipped to a point it has never seen before. 1 US dollar is now equal to about 90 rupees. That's the weakest the rupee has ever been. Think about it. Every time you go to fill petrol, buy something imported, or plan a foreign trip, this silent shift in the exchange rate has already reshaped the price you pay. It isn't just a number changing on a screen, it affects companies, students, families, and government budgets. In this context, let's unpack why did the rupee fall so sharply now? Who gains and who loses when currencies fluctuate? And more importantly, who ends up paying the real cost? If you are curious to explore these questions on your own, you can analyze the rupee exchange rates datasets compiled by our team at Dataful. Sourced from the Reserve Bank of India, these real-time datasets are clean, structured and ready to use, making the data analysis hassle-free. To download them, click the link in the description. Now back to the story. The first point to understand is why the rupee fell so much. Think of currency like a flight ticket. The more people want it, its price goes up. The fewer people want it, its price goes down. That's exactly how the rupee moves against the dollar. So when the rupee is weak, it simply means people want dollars more than they want rupees. The rupee has been falling because we buy a lot from outside the country. India imports oil, gold, electronics, machinery, all paid in dollars. So demand for dollars becomes high. Imagine you are buying a MacBook. It needs dollars before it comes to you. Also, foreign investors are pulling money out. They invest when things look profitable and exit when things look risky. When they pull out money, they sell rupees and buy dollars, pushing the dollar demand up. Further, our exports aren't rising as fast as our imports. We are spending more dollars buying stuff than we are earning from selling stuff. And on top of that, when global oil prices climb, we need even more dollars to pay for it, which increases demand for dollars. All these factors together push dollar demand up, and as a result, the rupee weakens. But it's not all bad. Some people actually benefit from a weaker rupee. Export oriented IT companies like TCS, Infosys, and Wipro earn in dollars, and when they convert those dollars to rupees, they earn more. Similarly, families receiving money from relatives abroad also get more rupees for every dollar sent. For example, $1,000 which used to convert to about 80,000 rupees earlier now fetches almost 90,000 rupees. Now let's look at who loses the most because of a weaker rupee. If you run a business that imports raw materials, components, or chemicals, suddenly your input costs shoot up. You have to spend more rupees to buy the same quantity. For example, automobile manufacturers, electronic firms, chemical processors, and pharma companies feel this pressure. Most importantly, consumers too face the impact. Fuel prices increase, mobile phones become costlier, studying abroad or traveling for work becomes more expensive. Even traveling to Dubai suddenly feels like traveling to Switzerland. And on top of all this, when businesses pay more to import goods, they pass those costs to customers. As a result, inflation rises, affecting everyday purchases. In the end, the summary is simple. When the rupee weakens, exporters and remittance receivers benefit, but importers, businesses, and consumers bear the cost. So, what do you think? Should India reduce its dependence on imports? Should we focus more aggressively on boosting exports? And will shifting to alternative energy help reduce our dollar demand? Share your thoughts in the comments below. Research for this story is powered by GoPy and Tagore.ai. To know more, click on the related links in the description.